Hello, I'm Lelda Smits for the Finance News Network, and joining me from Minack Advisers is Gerard Minack. Gerard, welcome back to FNN.
Thank you.
When we spoke in March last year, you said a global correction is coming on equity markets, but this year has seen solid gains. So have you adjusted your forecast?
Not really. I think the game changer will be when the market, particularly in the US, starts to price in the prospect of tighter Fed policy. I think the Fed will tighten next year. I think through the second half of this year, the market will start to anticipate that. In other words, what we're likely to see is curve flattening. And when you see curve flattening, you almost always see some corrections. So I think there's a great chance that we get a correction in the second half of the year. That may not necessarily end the rally. Every bull market has corrections. I think ending the rally is a story more for 12 to 18 months away. But a correction, I think, is a story for the second half of this year.
So as we are in the second half of this year, when the correction hits, what kind of falls are you expecting?
I think we're talking 5 to 10%. So if you're very nimble, it's tradable. If you're taking a strategic view, it will be difficult to play.
And looking at the interest rate environment in Australia, how long do you believe we can afford to have the lowest interest rates on record?
I can't see that the RBA is going to need to tighten anytime soon. I can't see that it's going to be happy to ease anytime soon. Put a gun to my head, probably next move is down, 12 to 18 months away. But for corporates, it's a new lower environment for top line growth that's going to make it more difficult.
Now, many are piling into cash with the view that stocks are looking expensive at the moment. How have you adjusted your portfolio?
Look, I like several themes, but I have to say I like each one of them less than I did 12 months ago, simply because they've run. Firstly, this is a low rate environment. Even if we get some tightening, through the cycle rates are going to be lower. So anything that offers a safe yield looks attractive. The banks fall into that category. I can't like the banks as much today as it was right to like them a year or two ago. They've had a cracking rally, but there's still some yield there. Secondly, if you can find companies that offer genuine organic growth, there aren't many of them, but if you can, I think the premium that you pay for them is worth more. When growth is scarce, the price of something that does have genuine growth goes up. But if you're a mum and dad investor, I'm happy to hold some cash. I think you'll get better levels to buy at in a range of assets, including property, over the next 2 or 3 years. Don't be greedy now. This is late in this cycle.
And finally, Gerard, in which sector of the Australian share market are you seeing the biggest risks, and where are there the best opportunities?
I think that as we head into next year, the miners are a highly cyclical stock, and their earnings, I think, have further to decline cyclically. I think domestically, the middle part of the market, the retail sector is struggling. And that's partly because the consumer is soft, partly because of structural change. The banks are the best of a bad lot, the least bad house on a bad neighbourhood. So you hold them for 12 or 18 months. But as I said, it's last innings for the banks. So look, there's a lot of risk out there. The one offset which would come to some companies' rescue is if the Aussie dollar fell. I think ultimately on a 3 or 4 year view, yes, it will be lower, but it's been slower coming down than I was expecting. And that means that I want to see it decline before I sort of start pushing some of the stocks that would benefit from a lower Aussie.
Gerard Minack, thank you so much for the outlook.
You're welcome.